Gold continues its slide, while US stocks also drop, led by large tech stocks. Expectations the Bank of England will cut rates are rising after weaker inflation data, and Bank Indonesia unexpectedly holds rates. That's coming up in our 5 Things in 5 Minutes on Thursday, October the 23rd. And then in our deep dive interview, ANZ Economist Krystal Tan analyses how Indonesia's authorities are looking to support growth.
We have all major policy levers: fiscal, monetary, quasi-fiscal. Everything's now working together to support growth.
But first, in 5 and 5 with ANZ, gold continued its slide overnight. It's down another 1% after yesterday's 6% slide. US stock markets also fell, led by large tech stocks. Meanwhile, in the UK, inflation surprised to the downside in September, rising 3.8% over the year after a flat month. ANZ economist in London, Henry Russell, says the closely watched services inflation number was lower than expected.
Overall, the better-than-feared inflation data followed a weaker labour market report out of the UK last week that showed moderating wage growth and signals services disinflation lies ahead. Taken together, these data releases have fueled expectations of a near-term rate cut from the Bank of England. Markets are now pricing in over 70% chance of a December rate cut, up from around 40% prior to the inflation data and around 20% only 2 weeks ago. We continue to forecast a 25 basis point cut from the Bank of England in December.
As of 4 a.m. Sydney Melbourne time, the S&P 500 was down 0.7% and the Nasdaq down 1.3%. The yield on the US 10-year Treasury was flat at 3.961%. West Texas oil futures rose 2.6% to $58.73 a barrel. Gold was down 1.1% at $4,064 an ounce. The US dollar index down 0.2%. The Aussie dollar flat at 64.92 US cents, and the Kiwi rose 0.2% to 57.45 US cents. Number 2, Bank Indonesia held its policy rate at 4.75% yesterday, against expectations for a cut. ANZ economist Krystal Tan says the central bank is waiting to see if new liquidity incentives lead banks to lower lending rates after 3 cuts since July.
Our base case is still for 2 more 25 basis point cuts in the current cycle, likely to be delivered by the first quarter of 2026. Now, the pace and timing of further easing will depend on both global market conditions and also how quickly banks pass on lower rates to borrowers and whether credit growth picks up to support domestic demand. So overall, BI remains accommodative, but the focus for now is on making sure policy actions translate into real economic momentum.
Number 3, Malaysia's inflation rate ticked up to 1.5% annually in September from 1.3% in August. ANZ economist Arindam Chakraborty says the increase was mainly driven by modest increases across food, utilities and transport prices.
As of 30th September, the government has reduced the price of RON 95 petrol to 1.99 ringgit per litre for Malaysian citizens, down from 2.05. This, along with favourable base effects and moderate domestic demand, should help keep price pressures contained in the medium term. On the monetary policy front, Bank Negara Malaysia lowered rates by 25 basis points in July to support growth. But given the strong growth performance in the third quarter, there's little need for further policy support in the near term.
Number 4, Japan's exports rose 4.2% in September from a year ago, the first increase in nearly half a year. Imports were up 3.3%, with the adjusted trade balance remaining negative amid all of these global tariff wars, says ANZ FX analyst Felix Ryan.
US shipments still falling though, down 13% year over year. That's the 6th straight month of contraction there. A large part of that is the decline in exports of automobiles. Again, due to tariffs, they're now down about 24% year over year. Outside of that, though, there was an increase in exports to Europe, up 5% year over year, and China as well, also up 5.8% year over year there. The main feature of the rebound in exports was a lift in semiconductor and electronic exports, mostly to Asia in general.
Number 5, New Zealand's sheep and beef farmers are receiving a much-needed spring bump to their prices across the board. Here's ANZ New Zealand agri-economist Matt Dilly.
Both beef and lamb are doing really well, and mutton and wool as well, and venison. So really, it's everything that's on a sheep and beef farm that you could think of is doing really well at the moment. And the main driver for that is just tight supply, both here and overseas, and really strong consumer demand. And that's in Europe, China, US, everywhere.
Matt Dilly there. Now, in our deep dive interview, ANZ economist Krystal Tan reviews Indonesia's recent pivot to growth.
So after widespread protests in August, it became clear that Indonesians were demanding real improvements in jobs and living standards. So the government responded quickly, With a new finance minister in place, Indonesia rolled out a series of measures. So there have been new stimulus packages, a more expansionary 2026 budget, and fresh liquidity injections into state banks. The central bank also delivered a surprise rate cut in September and signaled a stronger priority on growth. So basically, we have all major policy levers: fiscal, monetary, quasi-fiscal. Everything's now working together to support growth.
So tell me about this so-called 8+4+5 program. What does it include?
So in September, the government introduced the 8+4+5 program. So this included 8 short-term programs for 2025 worth 16 trillion rupiah, 4 that will continue into 2026, and 5 longer-term initiatives focused on employment. So the shorter-term measures range from food assistance, paid internships, tax relief, and also cash for work schemes, basically aimed at supporting household spending in the near term. Now, the policy momentum continued in October. Another stimulus package was announced last week. This time, it's worth 30 trillion rupiah. And the focus here is mainly on cash assistance for lower income groups and also expanded internship opportunities. It's important to note that even combined, these packages, they are modest in scale. Together, they account for about 0.2% of Indonesia's GDP. So they're designed to provide immediate relief to help shore up consumption. But for Indonesia to see a real lasting lift in growth, it's going to take more than short-term cash transfers.
And how important is the formation of a new sovereign wealth fund to these plans?
Now, Danantara is Indonesia's new sovereign wealth fund. It was launched earlier this year, and it's a big deal because the government is banking on it to play a key role in driving investment and also improving the efficiency of state-owned enterprises. So the fund will start to deploy capital from this month. About $10 billion is planned over the next few months. Early projects will include waste to energy initiatives and also the Hajj village development. So these are positive steps, but the broader economic impact will take time to materialize because Danantara has a very broad mandate, right? It's been tasked with restructuring state-owned enterprises, it's got to carry out projects with social impact, and it's also got to make financial returns. And some of the reforms it's tasked with, like restructuring state-owned companies, well, those are potentially politically sensitive and will require careful management.
Now, the Indonesian government is looking to increase bank liquidity. How is it doing that?
So the government has shifted a significant amount of its excess cash from the central bank into the state-owned banks. So the amount we're talking about is like 200 trillion rupiah. That's equivalent to 0.8% of GDP. So the goal is to encourage these state-owned banks to lend more. And so far, around half of that money has been dispersed. However, there hasn't yet been a broad-based increase in new loans across the banking sector. And that's in part because loan demand is still quite sluggish given heightened business uncertainty. So for this policy to fully support growth, banks need to turn that extra liquidity into new loans that fund productive investments.
What could lift ANZ Research's growth outlook for Indonesia?
Now, our confidence in Indonesia's potential for faster growth will increase if the following conditions are met. First, we need to see a clear and sustained increase in bank lending, with new loans actually going to fund real projects and businesses. Next, stronger job creation, especially in the formal sector. And rising real wages would be important signs that the benefits are reaching more Indonesians. It would also help to see the government's flagship programs being rolled out more quickly, with more visible results on the ground. Now, progress from Danantara, moving from planning to actually closing investment deals, will be another positive signal. And finally, all these needs to happen without causing instability in the currency or a spike in inflation. So if these markers start to line up, that would be a much stronger case for upgrading Indonesia's growth outlook. But for now, policies are promising, but the real impact remains to be seen.
Krystal Tan there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, October the 23rd. Catch you tomorrow with what to expect from inflation data from the US for September. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.